After the most recent rate hike by the Federal Reserve, mortgage rates shot through 7% on September 27th, according to Mortgage News Daily, which was the first time they've crossed that threshold since 2002. Since then, interest rates have dropped back down to about 6.75%. And this has been one of the sharpest increases we've seen in mortgage rates ever, going back to the 80s. And it's really starting to cause a massive slowdown in the housing market. Here in Southern California, where I help people buy and sell homes, the home prices are starting to drop on a month-over-month basis, and homes are taking much longer to sell than they were at the start of the year. In this video, we're going to be reviewing several forecasts specifically on the 30-year fixed-rate mortgage to kind of just let you know where some of the leading economists and researchers are expecting mortgage rates will end up at the end of 2022 and even throughout 2023. If you're thinking about buying or selling a home in Southern California, please feel free to call or text me anytime. I am more than happy to help you, look for a home, sell your home, or even just answer any questions that you may have about the housing market. My cell phone number is 714-486-4086, and I'll be leaving that in the description below. And if you like to stay up to date on the housing market, make sure you subscribe. We upload regular videos, all things real estate related. And if you enjoy watching the video, I would really appreciate it if you hit the like button. It really helps us grow our channel. First, we're going to be looking at the most recent September market forecast from Fannie Mae and taking a look at where they expect mortgage rates will end up in 2023. And if you've watched my previous forecast covering Fannie Mae, then you'll know that they have been predicting mortgage rates would be much lower in 2023 than they currently are today. And in their most recent September housing market forecast, they actually upwardly revised their expectations for mortgage rates by quite a bit compared to what they were expecting in their August forecast. And so we're going to be taking a look at where they're expecting mortgage rates to end up. And keep in mind that mortgage rates today are currently sitting around 6.75%. So for the fourth quarter of 2022, they're expecting an average 30-year fixed rate mortgage of 5.7%. And now taking a look at 2023, in the first quarter, they're expecting 5.7%. In the second quarter, they're expecting 5.6%. In the third quarter, they're also expecting 5.6%. And in the fourth quarter, they're expecting 5.5%. So as you can see, they are expecting interest rates to be about 1% lower than they currently are today throughout 2023. And keep in mind that these numbers were just upwardly revised from August, and these numbers are all about 1% higher than what their August forecast suggested. And now we're going to take a look at the forecast from the Mortgage Bankers Association. And they also upwardly revised their expectations for interest rates, although it was a much smaller revision than what Fannie Mae had done. And so according to their forecast, in the fourth quarter of 2022, they're expecting the 30-year fixed rate mortgage to average 5.5%. And then looking at 2023, in the first quarter, they're expecting 5.3%. In the second quarter, they're also expecting 5.3%. In the third quarter, they're expecting 5.1%, and in the fourth quarter, they're expecting 5%. So you can see that the Mortgage Bankers Association are expecting interest rates slightly lower than what Fannie Mae is expecting at this point, which for the housing market would be good news, as the market is highly sensitive to interest rates right now, and the higher interest rates that we're currently seeing are really having a large impact on how quickly the market is slowing down. So both of these organizations are expecting the 30-year fixed rate mortgage to be about 1 to 1.5% lower in 2023 than we're currently seeing today at about 6.75%. And I thought it would be important to point out that I went back and checked up on some of their forecasts from earlier this year, and the interest rates they were forecasting ended up being lower than what we actually saw in the market. So it's entirely possible that their forecasts now are still slightly low compared to what we're actually going to see. And one economist who thinks we could see these higher, more elevated interest rates throughout at least the beginning of next year is Mark Zandi, who is the chief economist at Moody's Analytics. And in a series of tweets that he recently put out, he stated that he was originally expecting the 30-year fixed rate mortgage would average about 5.5% throughout the spring buying season. And now he thinks 6.5% is much more likely. And as I quote, as is a darker outlook for home sales, home building, and house prices. Mark Zandi goes on to say that his forecast was off due to an extraordinarily wide spread between the 10-year Treasury and the 30-year fixed rate mortgage. And according to an Inman article that I was recently reading, going back to 2017, the average spread between the 10-year Treasury and the 30-year fixed rate mortgage is 2.05%. And so what that means is, on average, the interest rate on a 30-year fixed rate mortgage is about 2% higher than the interest rate on a 10-year Treasury. And so this could be explaining why a lot of these forecasts have been, lower than what the actual 30-year fixed rate mortgages end up being. Because if they're making forecasts based on a 2% spread and the spread ends up being 3%, then the 30-year fixed rate mortgage will be about 1% higher than what the forecast was expecting. And the Inman article goes on to say that part of the reason this spread has grown is because of an increased risk of early repayment of the mortgages. And what they're talking about is there's a potential that interest rates will drop if we go into recession. And according to Moody's Analytics, the risk of recession has grown to 59.5%. So, the people who are making these loans on the 30-year fixed rate mortgage, they're nervous that they're going to make a loan only to have the borrower turn around and refinance that mortgage within a few years after interest rates drop. So the people who are providing the money for these loans are padding their numbers there to make sure that they've got a little bit of an extra premium for the extra risk involved in the prepayment of the mortgages. So if you want to take a look at any of these forecasts for yourself, or read the article that I referred to by Inman News, just let me know. I'd be happy to send you links to those so you can take a look for yourself. And once again, if you're thinking about buying or selling a home in Southern California, please feel free to call or text me anytime. My cell phone number and email are in the description below. I'm more than happy to answer your questions and let you know what I can do to help. And once again, if you like to stay up to date on the housing market, make sure you subscribe to our channel. And please like the video if you enjoyed watching.